Welcome to the B.F. Anderson technical report for September the 17th. I've been getting a lot of questions from various clients and friends about what type of impact the election could possibly have on the market or the economy. And I think I've got two slides here that kind of make it kind of clear. So let's just look at this real quickly. As you can clearly see, the number one performing, now this is calculated on an annualized return basis from 1950 till 2019. So you can see here with a Republican Congress and a Democrat president is the ultimate return historically, which was 18.3% per year. Now the worst performance was where you had a Democrat Congress with a Republican president. Second best was where you had a Republican president with a split Congress like we have now. So it's just interesting, but I think the next slide really kind of points things out a little bit clearer. I think the real question is, does it make any difference? It really doesn't, because if you look at the returns, at least historic returns, since 1950, when you've got a Republican Congress, GDP growth rate has been 3%. When you have a Democrat Congress, GDP growth rate has been 3.3%, and a split Congress, 2.8%. So, I mean, really, if you think about economic activity and the political pressures that could come from that, historically, it really has been somewhat irrelevant. So let's get into the charts here. As we mentioned last week, look, we went with 1, 2, 3, 4, 5 months straight up. Historic rise. This was one of the highest returns over a 5-month period ever recorded in history. Then we saw an acceleration of the up move. Look, we just went up a little bit too much. This got a little bit too much white space in here. Then we had a waterfall decline of about 10% on the NASDAQ, and it looks like we're trying to consolidate in this range. Now, last Friday, we did break below the range, but then we came right back into it again. So basically, what it looks like today, and you can only deal with today. You know, one thing about trend following is there's no predicting. There's no predicting. It's all about taking your circumstances as they are today and evaluating them. Take it a day at a time. So as you can see is right now, what it looks like is we've had a 10% pullback. We're starting to consolidate. Maybe this is the worst is over. Maybe it's not. But it does look like to me it's not the beginning of a bear market. Because look at this weekly indicator. The 35-week is continuing to be in an uptrend. The actual price of the index, the NASDAQ, is above the 35-week. We're still in a bull market here. All of our monthly indicators, the S&P 500, Golden Cross. Next would be the NASDAQ, Golden Cross. Next would be China, Golden Cross. So the beauty of the monthly indicators is that we're trying to get a handle on where are we on a kind of a long-term basis here. The market's in an uptrend is what it's saying. Now here's the aggression index. As you know, we're comparing the NASDAQ to consumer staples, so we're basically comparing technology stocks to toothpaste and soap. Well, you can see here that we got red hot, got to an all-time new high on the aggression index, pulled down, broke below that 50-day moving average, but are trying to consolidate. Now realize here, we are making a higher low here. So that's very much of a positive. Here's the actual indicator, which is a weekly indicator. We have the 40-week moving average, the aggression index, the ratio is above this moving average, and that moving average is in an uptrend. So we're still on a buy signal on the aggression index. Now on the treasury yields, again, interest rates are just totally flat, not much going on there. Oil, again, showing weakness, breaking below that 200-day moving average and just moving sideways. Banks, financials, same thing. Interest rates and the banks are going to be somewhat correlated, and you can see that they're just really not going anywhere. Now, on these indicators here, this is the S&P 500 on a daily basis, comparing it to the 25-day and the 50-day moving average. Again, you can see the decline, starting to consolidate. Very important that we continue to hold above that 50-day moving average. As you can see down here on the 200-day moving average, no problem. We're still in a bull market as far as that indicator is concerned. But volatility index, this is so important. I've been spending more. I'm adding this actually to the weekly report, so we'll learn about this. Look, the lower the number, the less volatile the markets. The less volatile the markets, the more it will suck in more people, more investors, because they become more confident. I can remember back in the 1990s, the volatility index stayed low for 6-7 years. Now, as you can see here, we got a real big spike in volatility back on March 23rd, which was the beginning of the coronavirus bear market. But as we're starting to stabilize down here, we're actually down to a reading right now of 26, and anything below 30 is considered normal and an attractive situation. Now on new highs, you can see here, early August we got a bunch of new highs. They fell off. Then we got back going again in early September. Now they're falling off again, but kind of coming back. So new highs are not showing anything really toppy right now. In fact, it looks somewhat normal. And you can also see here the NASDAQ is starting to kind of turn along with the new highs. Now on new lows, which is really the most important thing, because if we're below 40 new lows and the market's hitting new highs, it means that the ship is sailing fine. If we start getting more than 40 new lows a day, like look back here in May, we got a real big spike in new lows. We're not having that problem, so new lows is not an issue. Now, I wanted to talk a little bit about the put-call ratio because I really feel that this told us about this correction that we're going through. Now, I'm going to show you the next slide, which I go back in history. Now, this is just our normal weekly evaluation of the put-call ratio. Now, this is where institutional investors are hedging their portfolios by buying puts and calls, options. So if they start buying a lot of calls, they're aggressive. If they start buying a lot of puts, they're defensive. So what happened here is we get readings of extreme greed and extreme fear. Now look here, extreme fear. This was March 23rd. Reading the highest reading. So let's just go to the next slide because I think you're going to see my point. This reading was the highest reading in fear since this has been calculated. It only goes back a couple of more years, but I can tell you, it is the highest reading of fear since the put-call ratio has been calculated. Then we went to extreme greed, and we went to the most greed that's ever been calculated. So these are just really unusual times where we're going from extreme fear because everyone's paranoid about the pandemic, which they should be, and then boom, we find out that, maybe the end of the world isn't here and people just getting too greedy. So at the same time, I'm just saying that if you get into a situation where you get into extreme greed to this level, you really need to think about being a little defensive with your portfolio. It just means that things are too hot. They're just too hot. So as we see this correction, this is the QQQ Trust, which is the top 100 stocks on the NASDAQ. You can see they broke the trend line, consolidating. So it's telling you that maybe technology is slowing down here. Now, this is a comparison. This is a ratio of the semiconductor ETF compared to the S&P 500. You can see that the semiconductors have been marching right up that trend line, marching right up. Then here recently in this current correction, we broke the trend line. But just like back here, we broke the trend line and then we reversed right back up again. That kind of looks like what's happening here. Now, semiconductors are being considered the next Dow Jones. I mean, it's like the railroads back in the 20s. Semiconductors are in everything. They're basically a commodity business, but a very important commodity business. Like here's Advanced Micro Devices. You can see this is a semiconductor, okay? You can see the breakdown that came during the correction. These stocks have had a major up move. They're going through a period of consolidation. This is KLA Corp, KLA Corp. They make equipment to make semiconductors. Well, you can see the massive drop off there. So I kind of feel that semiconductors might be in for a little bit of a stretch. Same indicator there. Then we go to another comparison, just something I'm looking at here. This is the S&P 500 as a ratio compared to Treasury bonds. So you can see since March 23rd, we've been S&P 500 has been outperforming Treasury bonds. However, this recent correction, but it still looks like to me this uptrend is intact, and it has recently broken a downtrend. So stocks are doing better than bonds, and it's just and that's a sign of, people being positive about the economy because bonds are defensive, just like gold is defensive. This is a graph here of the S&P 500 compared to gold, and you can see that we've been outperforming gold. However, this recent correction, we broke, the downtrend line. Now we're holding it. In other words, the market's doing better than gold, even though the price of gold has been recently moving up. But overall, stocks are doing better than gold. All right, let's look at the top 5. These are just some of the stocks that we would notice that have shown unusual strength. Tupperware. I really don't know what the speculation is here other than people staying at home eating leftovers. But anyway, the stock's strong. Digital Turbine. This is a technology stock, a software company. You can see that it's, broke. You can see this box here. That would be called like a Darvis box, Nicholas Darvis. And so you're breaking out above that box, and you're breaking out on above average volume. So that looks pretty darn positive. Freeport-McMoRan. We're talking about copper here. This is the big cyclical. Very steady up move here. Moved up here recently on above average volume. I think copper's looking kind of good. Here's L Brands, which is I think that's L Brands would be LL Bean, I'm pretty sure. But anyway, you can see, it's been, it had a gap up buy signal. It's held the gap, kind of messing around here, but it has been strong. Here is Penn National Gaming. This is a gaming stock. Now, we own the stock. We own Penn National Gaming, and we also own DraftKings, which is all about sports betting, and people are bored. They want to bet on sports, and they can do it with these guys using an app on a phone. So you can see the stock making all-time new highs, and the 10-day moving average is in a strong uptrend. You got a gap up buy signal right here. So looks interesting. Looks very interesting. Okay, that's it for the week. If you have any questions, don't hesitate to call. Thank you very much.